You've heard the rule 100 times. Save 3 to 6 months of expenses. It gets repeated like gospel, but for a lot of people that range is either way too small or more than they actually need. And getting it wrong costs you either safety or years of savings sitting idle. The right number isn't a slogan. It depends on your bills, how stable your income is, and how fast you could replace it. Today, how to size your fund for your life, where to actually keep it, and what really counts as an emergency. If nobody ever explained this, that's normal. That's why this channel exists. Quick note, this is general education, not financial advice. I'll point you to official sources like consumerfinance.gov and fdic.gov, and for your situation, check with a qualified professional. First, the big idea. An emergency fund isn't an investment and it isn't for goals. It's cash set aside to keep a surprise from turning into a crisis. A job loss, a car repair, a medical bill, a broken furnace. Its whole job is to be boring and available, so you don't reach for a credit card or a payday loan at the worst moment. That means we size it on the expenses it needs to cover, not on some round number someone repeated online. Here's the first correction to the myth. Size your fund on your essential monthly expenses, not your whole paycheck. Add up only what you must pay to keep the lights on. Rent or mortgage, utilities, groceries, insurance, minimum debt payments, transportation. As an illustrative example, if your essentials come to $2,500 a month, then 3 months is $7,500 and 6 months is $15,000. Notice we're counting survival expenses, not the streaming subscriptions and dinners out you'd cut in a real emergency. The second correction, how many months you need depends on how replaceable your income is. If you have one income, work in a niche field, are self-employed, or support a family on your own, a job takes longer to replace. Lean toward the higher end, 6 months or more. If you have 2 incomes, an in-demand skill, and few dependents, the lower end can be reasonable. Same rule, very different number, because your risk is different from your neighbor's. Let's make the range concrete with the same illustrative essentials of $2,500 a month. A lower risk household might target 3 months, about $7,500. A higher risk household might target 6 months, about $15,000. That's a real spread. Picking your number on purpose, instead of defaulting to 3 months for everyone, is how you avoid being underinsured against your own life or oversaving cash that could be doing more elsewhere. Now, where the money lives matters almost as much as the amount. An emergency fund needs 2 things. It has to be safe, and it has to be reachable in a day or 2. That rules out the stock market, where a downturn could shrink it right when you need it, and it rules out anything with a withdrawal penalty. It also rules out your checking account, where it quietly gets spent. The sweet spot for most people is a high-yield savings account, separate, safe, and liquid. But here's the mistake that quietly sinks emergency funds: keeping the money in the wrong place. Leave it in checking and it slowly disappears into everyday spending. Lock it in investments and a bad market can gut it the month you get laid off. The fix is a high-yield savings account, a HYSA, at an FDIC-insured bank. It stays separate from your daily spending. It's protected up to deposit insurance limits. It earns more than a normal savings account. And you can still move it to checking in a day or 2. Safe, separate, and liquid. That's the whole job. In about a minute, I'll give you the emergency fund checklist to screenshot, how to size it, and where to keep it in under 2 minutes. But first, where to start if that full number feels impossible right now? If 3 to 6 months of expenses sounds impossible today, don't freeze. Start with a starter fund. A common first milestone is $1,000, or 1 month of essentials, whichever feels more realistic. That alone covers the majority of everyday surprises like a car repair or a medical copay without reaching for a credit card. Build the starter fund first. Keep chipping toward your full target, and remember that even a partial cushion beats none. This is an illustrative starting point, not a rule for everyone. One habit makes the whole thing work. Automate it. Set a small automatic transfer into the high-yield account every payday, even $25 or $50 to start. You never see it, so you never spend it, and the fund builds in the background. As an illustrative example, $50 a week is $2,600 in a year, a real starter cushion built without willpower. Automation, not motivation, is what fills the fund. Now, the one thing nobody defines: what actually counts as an emergency? The test is simple. Is it urgent, necessary, and unexpected? A job loss, an urgent medical bill, or a critical car or home repair passes? A vacation, a sale, holiday gifts, or an upgrade you've been eyeing does not. Those are planned expenses you save for separately. Protecting the fund from fake emergencies is what keeps it there for a real one. And here's what to do after you actually use it. Because you will, and that's the point. Using your emergency fund is not a failure. It worked exactly as designed. The move afterward is to treat rebuilding it as your top savings priority until it's back to your target. Pause the extra goals for a bit, redirect that automatic transfer to the fund, and refill it. A fund you use and rebuild is doing its job. A fund you're afraid to touch is just money you're hoarding. Here's your 2-minute emergency fund checklist. Screenshot this. 1. Add up your essential monthly expenses, not your whole paycheck. 2. Pick 3 to 6 plus months based on how replaceable your income is. 3. Keep it in a high-yield savings account at an FDIC-insured bank. Safe, separate, liquid. 4. Start with a starter fund and automate a transfer every payday. 5. Only spend it on urgent, necessary, unexpected costs. Then rebuild it. 5 steps and your safety net is real. That's the map. Size the fund on your essentials, adjust the months for your own risk, keep it safe and reachable in a high-yield account, and protect it from fake emergencies. If this helped, the free Adulting Starter Kit in the description has this checklist plus a simple budget template. Next up, before you buy your first home, the closing costs and gotchas nobody warns you about. Subscribe so you don't miss it, and check consumerfinance.gov for the details.